Welcome to the Unfettered Wealth Podcast with Eric Tashlein from Connecticut Capital. In this podcast, we help business owners and successful professionals plan for better wealth outcomes. Join us for this journey where we explore ways to help you identify better wealth decisions to help you achieve an unfettered life. It's time to ask yourself, what do you want more of?
Hello and welcome to Unfettered Wealth with Eric Tashlein. Eric, good morning. How are you?
Hey, good morning, buddy. I'm doing great. How are you?
I'm doing fantastic. I'm really excited about today's guest. You brought somebody on. We were chit-chatting before we started recording today, and sounds like a pretty exciting guy.
Yeah, so Dean is really a rock star in the tax planning space. So Dean, good morning. How you doing?
I'm doing fantastic. Good morning, Eric and Eric.
So for those that are listening, Dean is Director of Investment Planning at SEI Trust Company, which is a major custodian and asset management company. I've known Dean for over 15 years, and his nickname, which is appropriate for today's topic, is the Tax Doctor. And I'm really happy to have him here. And just quick bio. So Dean's specialties really include portfolio analysis and design, individual income tax planning, retirement planning, estate, and trust planning. He is absolutely a nationally recognized public speaker on topics including tax planning and investment planning, which these days, I think with taxes being such a hot topic, I'm just so pleased to have you here, Dean. So good morning again.
Thank you.
So when we were speaking earlier in the week, Dean, one of your hot topics or conversations in your mind was Roth conversion. And I'd like to ask you, what are your thoughts on that, especially heading into, 2022?
Well, Eric, I think the Roth conversion is one of the best planning ideas for 2021. Mm-hmm. One reason why I say that is when you look at the four tax brackets, the four lower tax brackets, 10, 12, 22, and 24%, historically, they're quite low. And what they're talking about down in Washington is not lowering brackets, but increasing the tax brackets. And even if Congress doesn't change the tax law for next year, it's already built into the tax code that we're going to be back to the 2017 rates at the end of 2025. So it's in the cards that rates are going up. The reason why I like the Roth conversion so much, especially if you're married, is that the brackets are so wide, you can drive a Mack truck through them. For instance, a married couple can still be in the 24% bracket up to $329,850 of taxable income. So to me, it's a no-brainer to be thinking about Roth conversions in the 10, 12, and 22% bracket. But let me step back. Mm-hmm. What is a Roth conversion? What we're doing here is taking your traditional IRA, which is normally pre-tax money, hasn't been taxed yet, and converting it to a Roth and turning it into what's known as basically an after-tax account. And there are tremendous benefits to this. If you're the original owner of a Roth, there are no required minimum distribution requirements. Mm-hmm. Even when you pass on and leave it to your children, okay, they will have to take money out, but they can wait a whole 10 years before touching that Roth. So all through your lifetime and through 10 years of their life, they can let this account compound tax-free. And when the money does come out, it's not going to affect any of their taxation whatsoever because it's a tax-free account.
That's huge. And we started converting Roths, I think even before it was popular. It seems it's more than a decade ago, I believe. And we have some inherited accounts that have just snowballed into much larger accounts. And the recipients of these are just amazed. They're like, wow, I can take out all this money and not pay tax on it. I mean, I don't know about you. I'm sure it's the same on your end, but most of my clients are pretty tax phobic. So they love the Roth.
Yeah, and there are so many great other benefits for the original owner. So when you do tap into the Roth to manage your tax bracket, because effective tax management is using all your accounts, your taxable, your tax deferred, which is your traditional IRA, and then your tax-free, the Roth account. You'll never get the tax temperature right without having access to tax-free cash. And what the worst thing that could happen is you go into your early 70s and you have a $1.5 million IRA and a couple 100,000 in your checking account, that's a ticking time bomb. Okay, because as soon as you pull money out of the traditional IRA, you got to pay tax, and you got to pay more out to pay the tax. So it's terrible. You need to have this other bucket set up so that you can effect a good tax management program.
No,
and
absolutely.
when you do take money out of the Roth, it won't affect your Medicare premiums, which is important for a lot of the, when you get older and you're on Medicare, you don't want your premiums affected. Roth distributions will not affect that. Okay, because there's a 2-year look back on your income, but Roth distributions won't affect that. Okay, so that's a great benefit.
Yeah. No, for sure. So listen, I'm a big believer in that. And for those that are listening, we have, and obviously I have leaned on Dean and his department over the years for analysis work. We do Roth IRA analysis all the time, and just trying to fit in the proper amount, as you said, without skipping or jumping up a bracket. So happy to work on that with you in the future, Dean.
Excellent.
So beyond Roth conversion, I know there's some looming tax changes. They're talking about capital gains changes and so forth. When we were speaking earlier in the week, you're like, hey, listen, this is a good year. Sit down with your CPA and maybe talk about supersizing your charitable donations or your itemized deductions, I would say. And can you speak to that a little further for the audience?
Sure, Eric. And this is a great time to bring this topic up in reference to the Roth conversion, because look, no one wants to pay tax before they have to. And the Roth conversion is kind of making you do that, even though I would argue at those tax rates, it's really a smart thing to do. But what you could potentially do is pair tax strategies. And one of the things in the Biden campaign that came out is, especially for the upper income earners, he wants to devalue itemized deductions. So what do I mean by that? So right now, the top tax rate is 37%. Next year, they're talking about raising that to 39.6%. But itemized deductions today, there is no haircut. If you're in the 37% bracket, every itemized deduction is worth 37 cents on the dollar. Next year, they want to cut the value down to a maximum of 28 cents on the dollar. So you could be in the top bracket next year, 39.6, but your itemized deductions are only worth 28 cents on the dollar. So they're really devaluing the value of itemized deductions. We don't have that this year. This year, you will get full value of your itemized deductions. So this is an excellent year to accelerate deductions into this year, because you have some control here on your itemized deductions. It's a little tricky with some of the things. For instance, state and local tax is limited to 10,000. It's very hard to advance, let's say, your mortgage interest into this year. The two expenses that you can really play with, potentially medical expense to some extent, but even that can be difficult. But the one clear one is charitable contributions. And go ahead.
So go ahead. So basically, for those that are listening, so a donor advised fund, what you can do is you can stack. If you typically give, I don't know, 20,000 a year to charity, let's say, in a given year, maybe this year you consider 100,000 or more. You can put it into a donor advised fund, and that fund, which you have some say in terms of where those monies go, you can continue once it's in there to shell out that 20,000 a year, but you've taken a very large deduction in the current year. Is that how you would describe a donor advised fund, Dean?
Yes, it is a charitable entity, and what you described there is what I would call the lump and clump, which is basically accelerating future years charitable contributions into this year. That's the lump. The clump is, hey, I don't want to turn over 20, 30, 40,000 to a charity right now. That's not normally what I give per year. So you put it in this charitable way station known as the donor advised fund. And as soon as you put the appreciated securities in, or cash, for instance, you get an immediate tax deduction. And then you and your family, whenever you want in the future, can decide what charities will benefit from that money. And of course, once it's in the donor advised fund, it will grow tax-free.
That's fantastic.
So what you could do here is you could do, let's say, a $30,000 or $40,000 Roth conversion. And then if you increase your charitable contributions, you can marry the two tax strategies. meaning do a Roth conversion, increase your charitable contributions. It's a tax savings powerhouse, Eric.
That's great. How could you not do it, or at least not consider it, right? I think this is the year of considerations, and I think many folks will delay seeing their accountant or their financial advisors because hey, it's summer in the Northeast and it's boating season or golf season. But I think this year, with everything that's looming, I think it's a good idea to sit down with your team.
Absolutely. I mean, these are the kind of ideas that you want to pencil in at your meeting, and then when the fall hits, and we might get some clarity out of Washington, okay? Because if you're going to do a Roth conversion, it's got to be done by December 31st. If you're going to do more charitable contributions than you normally do, again, has to be done by 12/31. So you have a little bit of a runway here. So maybe it's September, October, November. You're really crystallizing your plans, and then you take action. So it doesn't have to be done today, but I think these things need to be on the agenda and certainly revisited in the fall.
Sure. So, Dean, I'd love for you to just mention as a follow-up on donor advised funds. We've done some work in this area over the years. In lieu of sending cash to a donor advised fund, what is another tax beneficial technique that you could describe to the listeners?
Well, in the case of charitable contributions, there has been tremendous amount of traction in what is known as the charitable lead trust. Now, let's differentiate the difference between a donor advised fund and a charitable lead trust. A donor advised fund is a one-way street, meaning you put the money into the donor advised fund. That money is destined for charity, and you'll never see that money again. You basically gifted it away. Now, with the charitable lead trust, and the one I'm going to talk about specifically is known as a grantor charitable lead trust, is a way to give to charity for a number of years through a trust, but the trust term will end, which you have something you will decide if the trust is going to last 5 years or 10 years. But after that term is over, the trust principal, the trust assets will return to you and your family. So essentially what you're signing up is to give charity X amount of dollars per year for a number of years. And when that term is over, you get your money back. Now, I'm not going to say it's going to be dollar for dollar because it will depend on how the investments do and so on. But if you do have sudden money events, or if some people, and we are recommending that people seriously bring in ordinary income into this year, which would be Roth conversions, non-qualified stock option exercise, deferred comp. If you're a business owner, defer expenses to next year, they'll be worth more. So raise your income up this year. But for people that have sudden money events, we're dealing with some people who sold their business and now they're looking for, they don't want to pay all those taxes. So they're asking for potential solutions. We're bringing up the idea of this grantor charitable lead trust. Because what happens here is you sign up to put money in a trust for 10 years and let's say give charity $50,000 a year for 10 years. What you get this year is the present value of that annuity stream that you promised to pay, but you get the deduction this year. So you're supersizing your charitable contribution in the year you need it most when you had the big income item. So you're marrying that together. And with this low interest rate environment, the value of those charitable contributions could not be higher. After the 10 years is over, guess what? You're going to get that principal back with carryover basis. So a lot of people like this idea of giving to charity, but they know that eventually the principal is going to come back to them. And again, when they're in this top bracket, they're getting the full value of those itemized deductions.
That's huge. So I'm going to step back. One of the things I mentioned earlier on donor advised fund as well, just in a compliment to everything that you've been saying, is I know, I think it was last year, we had some clients with very low basis stock. In lieu of making a cash donation, we actually transferred the stock ultimately to a donor advised fund. The nice thing is someday if they had held those stocks individually, they were going to have huge capital gains when they sold as part of their retirement income. We ended up buying those stocks back after we transferred some of those low cost basis stocks. So it just helped, that's like an additional tax planning technique if you decide to do the donor advised fund.
Absolutely. And I call that a twofer, because by giving away the appreciated securities to the donor advised fund, one, you got out of a big tax bill, and two, you got a charitable deduction.
Yeah, no, I think it's a win-win for all parties. And obviously, listen, it's New England. New England's notoriously tight-fisted when it comes to charitable giving. But if you can strike a balance between legacy, current income, and also, you benefit a charity. In some cases, it's a win-win-win.
You got that right.
So, talk to me. Any other trusts that you're seeing activity in this year, or trust planning techniques that you're using, or that you foresee maybe will having expanded use in the future? I mean, I think earlier in the week you mentioned the Islet as well and the CRT.
Yeah, let's talk about the Islet for a second. A lot of the tax law changes that came out in what's known as the Green Book, which is a way that the president highlights proposed tax changes. And some of the things that they're talking about are, frankly, a little scary.
Mm-hmm.
And they certainly want the one thing that if you would have asked me this in January, I would have said no chance, which is the elimination of the step up in basis, which has been the hallmark of estate planning. Meaning, if I had a tech stock that I bought for $100 10 years ago, and now it's worth $1 million, and when I die, my child would inherit that, but the basis would be stepped up from $10 to $1 million. So the tax bill would essentially go away. Well, they're talking about eliminating that step up, and that would be what's known as a realization event. And there could be a pretty hefty tax bill. Now they're talking about a certain amount of exemption for a married couple would be around $2.5 million, a far cry from what it is today, which is 11.7 million per person. Mm-hmm. So the last free lunch out there is life insurance, meaning there's been no change to the fact that if you set up an insurance policy the proper way and maybe put it inside a trust known as an irrevocable life insurance trust, when someone dies and the trust and the policy pays off, let's say it's $1 million life policy, the trust gets paid $1 million totally tax-free, which then of course could be used as a family asset for generations, known kind of like what we would call a dynasty trust, that the family could tap into that for health, education, maintenance, support, things of this nature. Or it could potentially be used to pay the estate tax on the other part of the family assets that were passed on at death, and that would be considered a realization event. So I really think that we're going to see a huge resurgence in the use of the Islet for estate tax reasons.
Sure. Now, and we've seen it, at our office. We've been involved with estate planning, obviously, for years. But it is cool when you see insurance work the way it's supposed to, and it's paid out tax-free, and then you see the second and third generations really benefiting from an education standpoint and from a life standpoint. It's just really a home run to have money growing, as you said, if you wouldn't mind, just if you could speak to the dynasty trust, because I just think that is an awesome planning technique or vehicle to incorporate into larger estates.
Sure. Now, even the Green Book, I actually addressed the idea of the dynasty trust, and I'll touch on that at the end. Okay. But the essential idea of the dynasty trust, and why we have these very generous exemption amounts, and hopefully some of the changes they've talked about in the Green Book, believe it or not, they want to think about doing them retroactively back to potentially April 28th or May 28th. That is even up for debate.
Yep.
But point being is I might say I have a rather large estate, maybe 30 million, something in that neighborhood, above the current exemption amounts jointly. But again, they could lower those exemption amounts significantly. That's what they've been talking about. So I decide I'm going to give $10 million to a trust, and I'm going to use my exemption. So when I transfer that into this dynasty trust, there won't be any estate and gift tax due because I have an exemption amount that will cover that. So it goes into the trust, and you'll set it up in a state, for instance, like Delaware, or potentially Alaska or South Dakota, where you could have these trusts that could last hundreds of years. And the family will have access to this money. It's protected from creditors and predators. And it's inside a trust. It's going to have professional money management. It's going to have professional trustees. And the family could tap into these trusts for whatever the trust document says. So if someone gets married, they get a bonus. They buy a house, they get money for a down payment. They go to college, it can pay for college expenses, computers, whatever the grantor of the trust wants the family to benefit from. But it could even be for children who are not even born yet. Okay. So and you can use your generation skipping tax exemption as well when you set this up. So if you named grandchildren right away out of the gate, you can use your exemption so there wouldn't be any GST tax. But the point of it is it's a family asset for generations, a la the name Dynasty Trust.
I think it's awesome that you're saying there may be some changes to that. So any in particular that are concerning?
Well, what they're talking about is a proposed gain recognition on unrealized appreciation of property owned by a trust every 90 years. So the first possible gain recognition would be for a trust that was established in 1940, and that would be in December of 2030 that we would have this gain recognition event. But my point here is that the wealthiest families in this country, the Mellons, the Carnegies, the Vanderbilts, the Rockefellers, this is what they've done, is set up this type of vehicle to pass wealth on from one generation to the next. And it does put some kind of governor and regulator on it as well. So the family is just not inundated with tremendous wealth. They have to, the grantor could make some conditions on how they would get the money from the trust.
Sure. So, and one thing I just want to interject, Dean, too. I mean, you guys are a major trust company. I know you have some billionaires that you handle their trusts and so forth. So, one thing I'll just interject on the podcast. So, when I see a lot of trust, I see often just handled by a law firm. And one thing that you can do within the trust firm, there's nothing against law firms or lawyers handling things as trustees. But I think what is cool with the trust company is you can have co-trustees. You could have a trust company and the attorney, or you can have the trust company and a key member of the family. I think it's just nice if somebody ends up pursuing this, to consider having a corporate trustee as a second set of eyes. And honestly, if it's a family member that's a trustee, it just takes some of the pressure off if you have little Johnny with his hand out every few weeks begging for money. So I just wanted to interject that. I think it's really powerful to have a trust company involved. And your particular trust company is probably the most reasonable trust service I've ever seen out in the market.
Yes. And another reason why you would want a professional trustee is we handle all the tax preparation. We handle all the trust administration. Naming your family member who may not want to be a trustee, or certainly don't want to handle all the admin of a trust, because they don't do it on a regular basis. They're not even familiar with state tax law or federal tax law. So they're really, I'm sure, would be rather apprehensive. They certainly wouldn't mind being co-trustee when they have a professional trustee handling these things. But to get to pricing quickly, when you have a trust with us in excess of $1 million of investable assets, we don't charge for trust administration. It's zero. Yeah. And that includes the tax preparation as well. And you won't find a more reasonable rate than zero.
Yeah, no, and for those that are listening, basically, I mean, SEI does have some lower cost exchange traded funds that they'll use on the trust portfolio. So that's how they get paid. But they're in it for the long haul. Similar to my office here. And I know Brian Park, my business partner, and I are just we're in this. We have a long-term focus, and I know you guys do too. So we like working with you when we can.
Yeah. And to bring these two concepts together, an Elliott, can essentially be a dynasty trust. So that could be the cornerstone of a dynasty trust. So you set up a trust, it would be set up in a state that has the rules against perpetuities. That means it could last for a very long time. And the cornerstone of the assets inside that dynasty trust could be an insurance policy or two, among other assets.
No, that's awesome. That's awesome. So, a couple other just cleanup issues on, listen, I know you don't have a crystal ball, right? I know they're talking about capital gain changes, which I hope I just hope clearer heads prevail on this, right? But do you want to just speak to that? Just some thoughts on that in terms of what can you do to escape some of those issues?
Yeah, this is a really tricky one, Eric. At the beginning of the year, the Chinese New Year that we're in is the year of the ox. And at the beginning of this year, I said for the trust world, it's the year of the CRUT, the charitable remainder unit trust. It was like it was God's gift to tax planning this year, because how can I recognize a big gain and not pay any tax on it through the vehicle of the charitable remainder trust, get a tax efficient cash flow for life, and get a charitable deduction up front? Okay, that's really what's going on with these CRTs. But now with the Green Book, they talked about potentially, again, going retroactive to earlier this year and essentially making that contribution to the CRT of appreciated property. That could be what's known as a recognition event. Like, it wouldn't be a tax-free transfer. And that was part of the beauty of the CRT, is that you could pop the appreciated asset, whether it be real estate, stocks, into the CRT, sell it inside the CRT, and it'd be no gain recognition, no tax bill, because CRTs don't pay tax. Now that's kind of put in a flux a little bit. And it's so now I think we need a runway to say, well, I think I've identified some assets that I might want to sell this year, but it may behoove everyone to hold off to see if we get some clarity. Because prior to this Green Book, we were gung-ho on setting up these CRTs. In fact, we've had the most business we've had in 5 years in doing these things. And then this Green Book comes out and it kind of put a little damper on this activity. And so we need to think about, well, what should we do?
Yeah.
And
oh, sorry, go ahead.
No, I was just going to say that, again, it's something that it needs to be on the agenda, but I think we kind of have to wait and see if we do get this retroactivity. I think the president and his council, they had some apprehension around people front running the tax law change next year. So doing all these advanced strategies now when the tax rates were favorable, the tax law changes effective 1/1/22, and everyone did all their planning, and they kind of escaped, to some extent, which may or may not be true. I mean, not everyone can time everything, and not everybody's going to do everything this year. But if you're looking at something this year or next year, you were certainly pushing it into this year if you could. So, but I don't really, and this is a very hard thing. I'm very bad about predicting the future, Eric. I'm very good about predicting the past, but I'm very weak about predicting the future. So,
and I get it. You don't want anybody to rely on something that, listen, it's Congress. I don't think they know what they're doing. So how are we going to guess what they're going to end up with? But, I hope though, having worked with so many business owners over the year, listen, I get it. You're a hedge fund person and you're making 50 million a year. The tax law changes there. I understand that. But sometimes you see these business owners, they're not making $1 million a year, but they've put 40 years into their business. And maybe they have a recognition event where their income goes well over $1 million and they get really taken on the chin. So I hope some of the nuances of the law ultimately have the spirit of not being punitive to people that really probably shouldn't and don't deserve it. So we'll see. We'll see. America has never been about having punitive laws. I hope that spirit continues in some form, and we'll find out soon.
Yes, certainly we do have news on the infrastructure bill. Now that didn't have any tax ramifications to it. It doesn't mean that they're not done. We do expect some type of tax bill to be brought forward, because the president can use budget reconciliation one more time this year, which means, of course, they have a slim lead in the House, the Democrats, and with budget reconciliation, they only need 51 votes in the Senate. So they have a 50-50 tie, and then, of course, the vice president, being Democrat, would break that tie in the Democrats' favor. So we do expect something to come forward, because we do have an election year next year. It's not a given that the Democrats would still maintain the House and the Senate. So I'm sure they're going to want to put forward this tax increase. It's been a big cornerstone to the Biden campaign. So we do expect some type of bill to be voted on this year.
Yeah, and listen, at the end of the day, as long as there's some compromise, if they raise it somewhat. I just hope they don't go to, because, what's the incentive if you're putting capital at risk to then go ahead and lose half of it? You're going to see a lot less investment into business or risky investments when that occurs. In my mind, there's no question on that. So I hope calmer heads prevail, and we'll see. Fingers are crossed.
Yeah. Well, look at the infrastructure bill. I mean, the president talked about a bill twice the size of the one that they just agreed to.
Mm-hmm.
So that was compromise, most definitely. So it was cut in half, is what they agreed to from the president's initial numbers, like 1.9 trillion. So point is that they got it done. It's great to see that that was a very much a bipartisan effort. So everyone agreed that infrastructure needed to be addressed. This tax thing is a different matter.
Right.
Because the Republicans would argue, no, we don't need any more taxes.
Mm-hmm.
But with budget reconciliation, they can vote strictly down party lines and it'll get passed.
So to be continued. I'm sure we'll do another cast once we have some clarity. But Dean, any other parting thoughts? We really do appreciate you being here.
My parting thoughts are this: have your tax return reviewed for 2020, understand where things are, what's happening this year that's different from last year, if anything. Put down some things as ideas that you're thinking about: Roth conversions, accelerating deductions into this year. Do I need some more advanced strategies that I need to look at, like the CLT or the Dynasty Trust? What are my insurance needs if the law changes with the exemption amount for estate and gift? And then come fall, you still have time, start to crystallize what plays you're going to call and get done before year end.
Yeah, that's awesome. And I would say if anybody that's listening has really enjoyed this, Dean, I always enjoy working with you. If anybody has questions, maybe they want to see some planning in terms of various trusts, Dean and I can work together on your behalf, and we're happy to do so. So for all those that are listening, thank you today. Hope you've enjoyed this cast. And Dean, thanks again.
My pleasure, Eric. And Eric, you guys have a great weekend. Thank you.
You too.
Thank you so much. Yeah, this is fantastic. Eric, you always bring on amazing guests. Dean, I can hear your passion in your voice. That's why you're the tax doctor, right? You get excited about this stuff, and obviously you know your stuff. So thank you so much for being on the show. And of course, our last thank you always goes to you, the listening audience. Thank you for tuning in and listening to the Unfettered Wealth Podcast with Eric Tashlein. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Eric comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at Connecticut Capital Management Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Unfettered Wealth Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Connecticut Capital. The content has been made available for informational and educational purposes only. Content should not be construed as personalized investment, legal, or tax advice. Please consult your advisor, attorney, or tax advisor in regards to your individual situation. Eric Tashlein is an investment advisory representative of Connecticut Capital Management Group, LLC, a registered investment advisor. Connecticut Capital Management Group, LLC, and Connecticut Benefits Group, LLC are not affiliated.